Missed NVIDIA's insane run from $120 to $700 plus? Don't worry, the AI data center boom is just getting started, and there are four stocks most investors have never heard of that could deliver similar explosive growth. We're talking about the companies building the actual infrastructure that powers AI, the data centers, the power capacity, the physical facilities where all those NVIDIA GPUs actually live and operate. One stock at $11.20 surged 208% year-to-date in 2025 and is the exclusive operator of Microsoft Azure in China with 297 megawatts under construction. Another at $14.29 just signed $17 billion in Google-backed AI hosting contracts and is pivoting from Bitcoin mining to become America's low-carbon AI infrastructure leader. The third, at $34.95, secured contracts with hyperscalers and is building massive HPC facilities across multiple U.S. locations. And the fourth, at $46.48, operates in Asia's fastest-growing AI markets with customers like Alibaba, Tencent, and ByteDance. While everyone chases NVIDIA, these picks and shovels plays are building the foundation of the AI revolution, and they're trading at a fraction of NVIDIA's valuation. The AI boom needs power, cooling, and physical space. These four companies provide exactly that. Could they be the next multi-baggers? Before I reveal which four data center stocks could be the next big AI infrastructure plays, and honestly, the growth numbers here are absolutely wild, welcome back to Smart Investing. I specialize in finding technology stocks, AI infrastructure opportunities, and companies positioned to benefit from megatrends like artificial intelligence, cloud computing, and digital transformation. If you want exposure to the AI boom beyond just NVIDIA and the chip makers, you need to hit that like button and subscribe right now. This is infrastructure investing at its finest. Let's dive in. The first stock is VNET Group Inc., ticker VNET on NASDAQ, trading at $11.20 with a $2.9 billion market cap. Formerly known as 21 VNET, VNET is China's largest carrier-neutral data center provider and a pure-play data center infrastructure company. Here's why this is massive. VNET is the exclusive operator of Microsoft Azure and Microsoft 365 services in China through a government-approved partnership. They're also a major data center provider for Alibaba Cloud, Tencent Cloud, and Huawei Cloud. Basically, every major Chinese hyperscaler relies on VNET's infrastructure. The company operates across two segments: retail colocation with 51,960 cabinets, primarily in Beijing, Shanghai, and the Greater Bay Area, plus wholesale data centers with 573 megawatts of capacity currently in service. But here's where it gets exciting. They have 297 megawatts under construction, with 88.4% already pre-committed by customers, plus another 490 megawatts reserved for future expansion. That's massive growth visibility. In 2025 alone, VNET stock has surged 208% year-to-date, making it the best-performing data center stock of the year. They just raised $400 million in bonds to fund Chinese data center expansion, and with China's AI infrastructure market growing from $14.47 billion in 2023 to $33.37 billion by 2030, VNET is perfectly positioned to capture that growth. At $11.20, VNET has targets ranging $6.50 to $27.90, with average around $15. Bull case sees $20 to $25 driven by China AI infrastructure build-out, Microsoft Azure China growth, pre-committed capacity coming online, and hyperscaler expansion. The 297 megawatts under construction is 88% committed. That's locked-in revenue growth. Bear risks include Chinese regulatory changes, geopolitical U.S.-China tensions, competition from GDS Holdings, or execution delays. Downside could be $7 to $9 if growth disappoints. VNET's exclusive Microsoft partnership creates an unassailable moat in China's cloud market. As the only operator of Azure and Microsoft 365 in China, they capture all Microsoft cloud growth in the world's second-largest economy. Hyperscale customers like Alibaba, Tencent, and Huawei provide diversification. The 297 megawatts under construction, with 88% pre-commitment, demonstrates strong demand visibility. China's AI infrastructure market, growing at 19 to 22% annually through 2030, positions VNET for sustained growth, pure-play data center exposure without technology risk. The second stock is TeraWulf Inc., ticker WULF on NASDAQ, trading at $14.29 with significant market cap growth momentum. TeraWulf started as a Bitcoin mining company, but has executed one of the most successful pivots in recent history, transforming into a leading high-performance computing and AI infrastructure provider. Here's the incredible transformation. In just 10 months, TeraWulf secured over 510 megawatts of contracted HPC capacity, worth approximately $17 billion in long-term revenue. In October 2025, they announced a massive $9.5 billion 25-year joint venture with FluidStack, backed by Google, to build 168 megawatts of AI data center capacity at their Abernathy, Texas campus. Google is backing $1.3 billion of the lease obligations, providing investment-grade credit support. Before that, in August 2025, they signed 200-plus megawatts of 10-year agreements with FluidStack, representing $3.7 billion in revenue, $8.7 billion if extensions are exercised. They also have a 72.5 megawatt lease with Core 42, worth $1.1 billion over 10 years. But what makes TeraWulf special is they're building zero-carbon, sustainable AI infrastructure powered primarily by nuclear and hydroelectric energy. Their Lake Mariner facility in upstate New York is 100% zero-carbon powered, and they're targeting 250 to 500 megawatts of new contracted capacity annually going forward. Q3 2025 revenue jumped 87% year-over-year to $50.6 million, with adjusted EBITDA nearly tripling. At $14.29, WULF has significant upside if HPC transformation succeeds. Bull case $20 to $30, driven by 510 megawatts contracted capacity converting to recurring revenue. Additional 250 to 500 megawatts annual additions, Google-backed contracts de-risking execution, and zero-carbon positioning attracting ESG-focused hyperscalers. Stock surged 22% on FluidStack JV announcement. Bear risks include construction delays, execution on massive build-out, Bitcoin volatility exposure, or hyperscaler demand shifts. Downside $8 to $10 if milestones slip. TeraWulf's pivot from Bitcoin mining to AI infrastructure leverages existing power contracts and facilities. The 510 megawatts of contracted capacity with Google backing creates multi-year revenue visibility. Zero-carbon positioning differentiates from competitors. 100% nuclear hydro-powered infrastructure attracts sustainability-focused hyperscalers. Repeatable JV model with FluidStack enables rapid scaling without massive upfront capital. Project-level financing preserves balance sheet flexibility. The combination of power availability, low-carbon credentials, and investment-grade contracts positions WULF as infrastructure as a service for AI. The third stock is Applied Digital Corporation, ticker APLD on NASDAQ, trading at $34.95. Applied Digital is building next-generation data centers specifically designed for high-performance computing and AI workloads across the United States. The company operates in two main segments: data center hosting and cloud services. They've developed expertise in building facilities optimized for GPU-dense computing, the exact infrastructure needed for AI training and inference. Applied Digital focuses on securing low-cost power contracts in strategic locations, then building purpose-built facilities around that power capacity. They're developing multiple sites, including facilities in North Dakota and Texas, where power is abundant and cost-effective. The company has signed major hosting agreements with hyperscale cloud providers and AI companies looking for massive compute capacity. What differentiates Applied Digital is their focus on next-generation liquid cooling technology and high-density power delivery, critical for the latest AI accelerators that consume far more power than traditional servers. They're also pursuing opportunities in both colocation, leasing space and power to customers who bring their own equipment, and cloud services, providing compute as a service. With AI models getting larger and more power-hungry, Applied Digital's infrastructure-first approach positions them well for the coming wave of AI infrastructure spending. At $34.95, APLD is positioned for growth if they execute on contracted capacity. Bull case $45 to $60, driven by hyperscaler contract conversions, new facility completions, AI infrastructure spending surge, and power scarcity making their low-cost contracts valuable. They're building in locations with stranded power resources. Bear risks include construction delays, capital intensity requiring dilutive financing, customer concentration, or competitive pressure. Downside $20 to $25 if development timelines extend or demand softens. Applied Digital's strategy of securing low-cost power first, then building infrastructure around it, creates structural cost advantages. Their focus on high-density, liquid-cooled facilities positions them for next-gen AI chips requiring 2 to 3x more power than current generation. Geographic diversification across multiple U.S. locations mitigates regulatory and power supply risks. The dual approach of co-location and cloud services provides flexibility in monetization. If AI infrastructure spending accelerates as predicted, Applied Digital's purpose-built facilities could command premium pricing. The fourth stock is GDS Holdings Limited, ticker GDS on NASDAQ, trading at $46.48 with a substantial market cap, making it one of Asia's largest pure-play data center providers. GDS operates carrier-neutral, cloud-neutral data centers across China and Southeast Asia, serving major hyperscalers, cloud service providers, and large enterprises. Their customer list includes Alibaba Cloud, Tencent Cloud, ByteDance, TikTok's parent, Baidu, and major global cloud providers operating in Asia. GDS operates data centers in Tier 1 Chinese cities, including Shanghai, Beijing, Shenzhen, and Guangzhou. Plus, they're expanding into Southeast Asian markets like Singapore, Malaysia, and Indonesia to capture regional growth. The company focuses on wholesale data center capacity leasing to hyperscale customers, which provides stable, long-term contracted revenue. GDS has significant capacity under development, with multiple facilities in construction or planning stages to meet growing demand from cloud providers and AI companies expanding in Asia. What makes GDS attractive is their pure-play data center model with no technology or services complexity. They simply provide state-of-the-art facilities, power, cooling, and connectivity. As Asia's digital economy grows and AI adoption accelerates across the region, GDS is positioned as the infrastructure backbone supporting that transformation. At $46.48, GDS offers exposure to Asia's data center boom. Bull case $55 to $70, driven by Chinese cloud market growth, Southeast Asian expansion, AI infrastructure demand, and capacity under development converting to revenue. Major hyperscaler customers provide stability. Bear risks include Chinese regulatory environment, competition from VNET and others, capital intensity, or regional economic slowdown. The stock trades at premium to book value, reflecting growth expectations. Downside $35 to $40 if growth disappoints. GDS's scale across Asia's fastest-growing markets creates competitive advantages in power procurement and facility development. Their pure-play focus on wholesale data centers for hyperscalers provides predictable, long-term revenue streams. Relationships with Alibaba, Tencent, ByteDance position them for AI infrastructure growth as these companies scale AI capabilities. Geographic diversification into Southeast Asia mitigates single-country risk. As Asia's cloud and AI markets grow faster than Western markets, GDS captures that regional growth premium with established infrastructure presence. So there you have it, 4 ways to play the AI data center boom beyond NVIDIA. VNET at $11.20 for China exposure with Microsoft exclusivity and 208% year-to-date gains. TeraWulf at $14.29, transforming from Bitcoin mining to $17 billion in Google-backed AI contracts. Applied Digital at $34.95, building next-gen HPC facilities with low-cost power. And GDS at $46.48, dominating Asia's hyperscale market, with Alibaba, Tencent, and ByteDance as customers. Each offers different geographic exposure, risk-reward profiles, and strategic positioning. What's your take? Which data center play has the most upside? China growth, U.S. transformation, or Asian hyperscale? Are these the picks and shovels of the AI revolution? Drop your analysis in the comments. If this comparison helped you understand the data center landscape, smash that like button and subscribe to Smart Investing for more AI infrastructure stock breakdowns. Remember, educational content, not financial advice. Do your own research. Thanks for watching.